Now, the part of our show that I get asked probably most about, which is the top three things that individual investors need to keep an eye on before you make your investment decisions. We always seem to have economic data on the list. We recently received inflation data in Canada. CPI was reported, Consumer Price Index, and PCE, which is the preferred, data by the Fed. PCE, personal consumptions and expenditures. This data will be coming out this Friday. Again, very good indication as to how inflation is going in the US. And we already had the numbers out of Canada with regards to inflation. We saw tick higher in core inflation, but our headline number came in as expected and as many were anticipating. Trim gains and buy lows. This is what I've been doing for a lot of investors. I'm going to show you when we were buyers, and now on some names, we are trimming some of those profits and moving that money to buy companies that are at low points once again. That will be next month's or perhaps in the future, winners to come. Number 3 point that I wanted to touch on for individual investors to consider: interest rates on GICs and bonds. They're not much of an option anymore. Perhaps TINA, T-I-N-A, the acronym TINA, there is no alternative. Perhaps that has come back into play and one of the main reasons causing this market to move higher. So let's move on with the first point, which is economic data, CPI and PCE. As I mentioned, headline CPI in Canada, 1.7%, and came in as expected. When you take core inflation, less food and energy, also remained a little bit more elevated than expected in the high twos, getting close to 3%. Not the way I think Bank of Canada wants to see it go. It'd rather go in the opposite direction. At the end of the week, we're going to get information or data on PCE, US inflation numbers, and it's going to be a big number. A lot of people will be looking at this number. I'm sure the President of the United States will be looking at this number. If it's a low number, I'm sure he will be putting more pressure on the Federal Reserve to cut rates. Jerome Powell and the Fed as a whole will be looking at this number as well to talk about when the next cut will be. So let's take a look at our first chart. Bank of Canada, key interest rate versus inflation. There you have it. Our inflation rate right now coming in at 1.7%. A policy rate coming in at 2.75. That is what the Bank of Canada is key interest rate versus the inflation rate. So again, you have about a 1 percentage point difference between the Bank of Canada rate and the inflation rate. Many people believe that inflation rate will start to go higher in the coming months. Our next chart, Canada CPI versus core CPI. And you can see there, it's getting closer to 3% again, 2.6. And you can see the headline number there at 1.7. Is it moving higher? Well, I think you can see the headline is kind of stable, but definitely the core number is on the way up, which again, Bank of Canada does not want to see. Next chart, US Consumer Price Index, 2.8% as a core reading, 2.4% as a headline number. And I guess to me, the number is obviously important, but it's the slope of the curve, right? And really, you're not seeing much increase in the data right now. Again, one of the reasons why many are calling for the Fed to cut rates, because inflation is just not moving higher as yet. And I know Jerome Powell in his recent meeting has said that he believes that they will see significantly higher inflation in the coming months due to the tariffs that are placed on goods coming into the United States, and perhaps tariffs that may be put back on goods coming into the United States if trade deals are not made. Our next chart here is PCE. You can see PCE data. 2.5% is when you exclude volatile food and energy, and 2.1%. So pretty much at the Federal Reserve's target rate. And again, low inflation, not seeing it go up. In fact, you could argue that it's actually come down since the last reading. So this reading on Friday of PCE will be extremely important to the markets. If we see a big bump or a rise, I think the Federal Reserve or Jerome Powell will have a big smile on his face. One of those days where I think he would want to say, I told you so. But if the rate is still low and doesn't move higher or actually moves even lower, perhaps it's the President of the United States will have a smile on his face and continue to put pressure on the Fed to cut rates. So this week, big for inflation data. We already received Canadian data, and on Friday, we will receive US data as well. The next point I wanted to touch on for individual investors to focus on before they make their investment decisions is this whole idea about where are we in the cycle, right? Are we at the highs, the lows in the market? Obviously, for those of you that follow the market, we are back at all-time highs right across the board, whether it's Toronto, whether it's New York, NASDAQ, Dow, S&P 500. We are at pretty much all-time highs once again, or just off all-time highs. I think less than 1% in some cases. So what I wanted to show and talk about today is how I think about buying individual stocks at this point. You know, back a few months ago, middle of April, when we saw, well, as we just showed, the S&P 500 charts, markets sold off substantially, we were a buyer. You know, I was buying things on the cheap, and we even spoke about it on our shows. Now, I'm still a buyer. I think you're always a buyer into this market. You can never time markets. But not only am I trying to buy things, obviously, at a low price with good value, and if they pay dividends, even better, but I've been a trimmer of some of the profits. And so wanted to show a couple of charts which will clearly illustrate how I think and how I think individual investors should be thinking when you decide whether to sell or whether to buy an investment idea. Our first chart is Broadcom. We can pull it up here. Now, this is a one-year chart, or sorry, a year-to-date chart. And you can see the sag again, like a lot of the charts I've shown you already, sag in the middle, that is back around middle of April. So clearly, middle of April, stock was trading in around $150 a share. There you have it. You're not going to be trimming the stock at those levels, but you probably would be a buyer because the stock was much higher prior to that in the 250 range. So at 150, how can you not be a buyer of Broadcom? A fantastic diversified company, obviously, or I should say recently, getting a lot of praise for its AI chips, its custom chips. And that's probably been the biggest reason for the stock to move higher prior to April, and probably the biggest reason for it moving back up recently. So I went from a buyer in April to a trimmer. Someone who trims some of the profits, take a little bit off the table. We may not want to let everything ride on one name like this. The prices are pretty high. Valuations have gotten higher. Maybe you take some profit off the table. Now, I think I would be foolish to tell you Broadcom is not going to go higher from here. So a lot of investors say, well, why are you selling it if you still think it's going higher? Well, it's all about risk management, right? You want to take some risk off the table. You want to sell some, but keep some in, because I do believe over time this name can continue to move higher. I just want to reduce the risk by trimming some of the profits. Our next chart, we have another chart of Broadcom, and you can see just in 1 month alone how much this stock has moved up. And I would say in the last month, that is when I've begun trimming some of the profits for some investors, if it makes sense with respect to the weighting in their portfolio. So, you know, if you're someone looking today and you're thinking, you know, should I be taking some of the profits in Broadcom? The answer is perhaps. We have to take it on a client or investor by investor basis, and we have to see, you know, how much of a Broadcom do you have in the portfolio? What is it? What's the percentage that it makes up of each portfolio? So there's a lot that goes into it, not just, you know, trimming profit. You want to take a look at where that stock fits in the whole scheme of the whole portfolio. The next stock I'm going to show you, it's Celestica. Now, you're going to notice that Celestica says $145. And for all you savvy investors out there, you're probably thinking Celestica is a lot higher than that. And it is in Canadian dollars. And this is actually Celestica in US dollars. But it will still show what I want to show, which is like Broadcom, Celestica, very much an AI play in the Canadian space, electronics manufacturer in Canada as well. very big tech name. Probably them and Shopify are two biggest. So Celestica pulled back in April. Probably would have been a great idea to buy on the cheap if you had the stomach to buy, because as we know, a lot of people, when stocks pull back, you may not be so confident to buy. As it started to move higher, and Canadian dollars, it's approaching $200 a share once again. Perhaps you start trimming back some of the profits and leaving a good position in the portfolio, but take some profit off the table. Once again, we have a chart on Celestica, our next chart, which shows the 1 month gains. And again, like Broadcom, Celestica has been on a fantastic run, exceptionally higher. Our third chart, I think our last chart in this segment, or this part of our top three, is one on JPMorgan. JPMorgan has moved also higher. You can also see the sag again in April. That would be for pretty much every stock, I would think, especially growth stocks or stocks that are purchased for growth. And once again, you're probably trimming back some of the gains in the last month or so as JPMorgan has moved significantly higher. So what I wanted to get across as my point is you want to trim some of your winners, take some profit off the table at this time. I think that's the prudent thing to do. Use that money to buy into investments that have not moved higher as yet, that you think will be tomorrow's winners. So take money from yesterday's winners to add money to investments that are still good value and lower for tomorrow's winners. Sell high to buy low, or buy low to eventually sell high. Something that we all have heard many, many times. Our third point that I wanted to get across to individual investors is this idea about fixed income. A lot of individual investors talk about asset classes such as stocks or bonds, GICs, gold, etc. And one of the things I've noticed, once again, and I mentioned off the top of the show, are that GICs and bonds just, unfortunately, just don't cut it right now. If you're looking to grow your portfolio, GICs from your big top 5 or 6 major banks, right now, they're paying somewhere between, let's call it generously, 2.5%, 3%. You might be able to get something between 3%, 3.5%. And so to me, that just doesn't work. If you have to pay half of that to tax or a portion of that to tax, then you subtract the inflation rate, the real rate of return on that investment, it could even be negative, which I will show you in just a moment. Our first chart is a chart on 1 and 5 year GICs. You can see here clearly how they're following each other and how they're pretty much at the same level. So the market's not paying you more for a 5 year as they are compared to what you're getting on a 1 year. That when we say that the yield curve is relatively flat. It has steepened a little bit in the last 6 to 12 months, but definitely we would like to see this steepen a lot more. Our next chart, which I alluded to just a moment ago, is the real rate of return of GICs, real rate of return of a GIC. And I guess for our purposes, you can see here in the gold how many times that gold line falls below the break-even mark. So that's the 1 year GIC, a real rate of return after tax and inflation. You can see the dark line is a 1 year GIC returns, and the blue is after you pay tax, and they just arbitrarily use a 40% marginal tax rate. And then you can see the gold is basically the return after tax and inflation. So all of you that are out there right now that are sitting on bonds and GICs, yeah, they're great for protection. There's no doubt about that. Most people buy these products for the low risk aspect. They know that they're not going to fluctuate an awful lot. But the reality is, unfortunately, you're just not going to make an awful lot as well. Our last chart here we can show is a chart which shows what interest rates are for Government of Canada bonds. And you can see there, that's what I was talking about. You're talking a 1 to 3 year. You're talking, in that 2.6, 2.7 range, 3 to 5 year, a little bit higher, 5 to 10 and over 10, you're getting, in that 3.5 range. So is taking a 1 year versus a 10 year worth it? Getting 3.6 versus 2.6 or 7 to get that 1%, you got to tie your money up for 10 years? Probably not. And so to me, right now, TINA does apply. I don't think individual investors, when they're getting 2-3% before tax and inflation, just not enough to grow your wealth and grow your portfolio. So keep that in mind as well. when you are considering your investment decisions, along with the economic data that will be released at the end of the week, the economic data that was already released earlier, and this idea of, don't let it all ride. Trim some of those profits. It's the prudent thing to do. I'm not saying to try and time markets, but as your investment moves higher, I think it's always a good idea to take some profit off the table.